Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been America's foremost precious metals brokerage firm since 1972, helping you build a strategic precious metals portfolio. Call 800-525-9556 to buy gold, silver, platinum, or palladium today, or go to McIlvaney.com. Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. It's an honor to be here with you again this week. And we finally are seeing gold and silver in positive territory for the year. We did have a good close in 2021, but what that resulted in is a little bit tougher numbers to overcome as we started 2022, but we are there. Miles, why don't you show us what gold has done since last week's show?
Yeah, Tori, it's interesting. Since the beginning of the year, we're up about $12 on gold. Gold's currently sitting at around $18.40, but we're up around $60 on gold from the low point from earlier this year. We did break below 1800 as we've been short-term stair-stepping up towards the long-term compression ceiling that we've been following in gold since about July, August of 2020. So it has been a long sea wave correction in the precious metals market, in gold specifically, and it's very likely we're going to make at least another touch on the upside. I would expect to see gold up anywhere from another $20 to $40 over the next week or so, get up into some of these declining highs. And if we start to see some breakouts, I hate to use the scary B word, but if we start to see some breakouts and start to see gold exceeding some of these previous highs. Our high back in November of last year at around 1880, our high back in May of 2021, 1920, 1950 prior to that. So a number of points between, say, where we are now in 2000, a number of potential ceilings in the 1900s. But I think once you build some momentum on the upside, you're going to find us blowing right through a good handful of those. So look for a breakout. Could happen.
What are the key numbers that we need to cross? Is today significant for any reason at this 1840 level? Did we break through anything that the listener would garner some valuable information from?
No, at 1840, at least the way I look at charts, I don't see anything specific at this number. I do think the next major hurdle we have to get over is obviously the declining trend line, which we're very close to. If we shot up right now $5, we'd be above it. Then after that would be around 1880, which would have been the high back in November. And then, of course, the one back in May at around 1920. So those are the next two numbers we need to get above. I've mentioned this a couple times over the last few weeks. Just breaking above that declining top end of the triangle does not necessarily a breakout make, because we've done that repeatedly. And you can see on the chart here, we've continually extended out the top end and therefore the duration of how long this pause is going to last.
So this could just be another example of that, you're saying?
It could just be another extension, but that's going to end eventually. I mean, the math doesn't work that way. You can't just draw something out forever. And I think there are some very good geopolitical and economic reasons we're going to get to at the end of the show explaining why you can't just draw out gold sideways forever.
Well, one of those fundamental reasons even is just seasonally. This tends to be the time of year when people sort of back up and start to load up again on gold and silver in their portfolios, in hedge funds, wealth funds, that sort of thing. So January, February, we expect some of this price action. Up 60 from the low is very positive. We need to keep going. We also, if you look at some technical analysis, we'll go into the ABC D wave. We're still in a C wave climb. That has not changed, and it's totally normal to pause in bull market activity like this. But what about silver? Like, it's outpaced gold. The ratios come down from 82 down to 76 here just in a matter of 2.5 weeks. What are you seeing silver-wise? And I'm going to ask you the same question. Has this been substantial enough to cause you any sort of hope that we've broken through some key technical resistance levels to the upside?
Also not quite on silver. Now, silver was at the bottom end of its trading channel. We actually did say on last week's show we expected silver to take a jump up this week, and that's exactly what it did. We went from a little over 22 to a fair bit over 24, so almost a 10% rise since the bottom. And the next major number I'm looking for in silver is going to be putting us above, let's say, 25.40. That would be the first key number I'd want to move above, and probably that means putting us up into the 26 or 27 range with a correction back down to 25. So you always want to see something kind of exceed where you want it to go, and then instead of using that number as a ceiling, it's now using it as a stair step on the way back up. So we're a couple bucks away, but shoot, silver just did a couple bucks in a week, so there's no reason it can't do it again.
Sure. No, that's where the volatility lies. Same thing with platinum. It's had a great week, really a great 2 weeks. Good start to the year. Walk us through those charts.
Yeah, same with platinum. Platinum looks very similar to silver. We had this kind of short-term rising channel. Platinum just exceeded its rising channel. Same concept, bottom at around 930. We're now at 1030. We're up $100 on platinum. Same as silver, my next high point would be this previous high at around 1100. I'd like to see us exceed it, take a step back down to it, and start building some stair steps up towards a legitimate breakout that takes us to the old highs in the 1300s. Platinum and silver both very strong looking right now, even though they're at the bottom end of their trading ranges.
And these are still not only hold positions, we still look at these as buy positions. Like, you're still being given a great opportunity to add to ounces. Remember what you do. You always acquire physical ounces over time on a cost averaging standpoint, some positions larger than others as we see opportunistic entry points. But the economic recovery is just not there. We've got this L-shaped non-recovery in the economy, COVID numbers continuing to climb. The fact that gold's holding solid is good, and all of that coinciding with some relative dollar weakness. We went into good detail last week on that show. The dollar sure didn't last below 95 on the dollar index for very long. We're right back up to 95.5 and sort of stuck there. Any news or any images to report on that?
Yeah, but I think you've really got to look at the dollar chart over the last year, not just the last couple weeks, because that dollar chart is just cascading over the edge. And if somebody other than you or me, or the average person out there, somebody who might have, say, a printing press, doesn't do something about it, it's very likely we could see the dollar continue down. The only thing that's going to intervene in the dollar is going to be the people who decide what the value of the dollar and the interest rates are. The dollar did bounce back up. It took a nice strong bounce from sub 95. We're at about 95.6 now, but it's come into, again, ceilings become floors, floors become ceilings, and it's very likely the floor at around 95.6 just became a ceiling. So I will be very interested to see how the dollar reacts to this over the next couple weeks.
I will too. Yeah, that's a really good point. I'm going to be interested to see how all of the markets react in the coming weeks, because you've got a lot of weakness in the equities markets, and for rightful reasons. If you just look at the index values, you don't even see the whole picture. Stocks are off to a rocky start, that's true, but under the surface, things are far more volatile than I think anybody realizes. Here's some key takeaways that are shaping up for a bear market trend initiating in the equities markets, a rollover in the economy, a failure for the stimulus to have worked beyond what it can do now. Even Chairman Powell said the economy and the markets are showing us that they no longer need our stimulus. So we're willing to accept our stimulus in a sense. So listen to this. More than 220 U.S. listed companies with market caps above 10 billion. So these are huge companies, market caps above 10 billion. 220 of them are down at least 20% from their highs. Okay, 220 of them are in bear market territory. And the NASDAQ composite's been the worst, right? It's particularly turbulent. Around 39% of the stocks in that index have at least halved from their highs. They're down 50%. 39% of the NASDAQ stocks. Nobody talks about it because the NASDAQ composite's only off about 12. Well, the reason that is even though that index was up 21% on the year last year, if you remove the 5 largest stocks, the index is down double digits. That's unprecedented divergence. They love to distract you with the fangs and tell you that all is well. But the S&P 500, it's been recently at a new high. 2/3 of the individual stocks are at 52-week lows, lowest point for the year, and yet it's somehow still hitting highs. That's what Fed stimulus does. That's what juicing the market does. And it hasn't been this bad since 1999 around the dot-com bubble, where so many NASDAQ stocks have fallen so far while the index was still that close to its high. That divergence is unprecedented, other than the last time we had such a big market bust in tech stocks. So buyer beware, holder beware. It's really time to position, really good time for you to be moving some riches that you've gained in the last 10 years, slide them over into safety and position your assets into a far more conservative hedge position. And let's watch and wait. There's going to be great value out there when you let the markets correct and you don't just sit in cash, you sit in something that moves opposite of cash like gold. And now you're primed and ready for the next value where you then leave that cash and trim that gold position and you move back into the equities so that you can ride the next wave up.
And I'm glad you bring up the NASDAQ, because looking at the NASDAQ charts, like you were alluding to, it's the handful of big boys, the big ships that are pulling everybody behind them. But the reality is since December 27th, the NASDAQ's off 1,500 points. That's almost 10%. And if we get down another 500 to 1,000 points on the NASDAQ, well, now you're putting in significant lower lows. Now we're below the October 4th low at 14.5. Same with the Dow Transports. The Dow Transports are right at the bottom edge and looking like they're going to break down like the NASDAQ did. And if the NASDAQ declines, the S&P is going to follow suit. The Dow Industrials are going to follow suit, and the transports are really close to following suit. So this could be just starting the snowball rolling down the hill with the expectation of the interest rate rises coming this year. Goes to show what's actually been propping the market up, and it sure as heck hasn't been your and my 401k for the last few years.
That's right. They're reducing stimulus. They're talking about reducing the Fed balance sheet, which means trimming their positions, the assets that they've acquired in the last number of years. The interest rate hike, everybody's talking about the inflation coming in at 7%. We like to refer to the Shadow Stats alternate inflation index because John Williams measures it the way that it used to be measured prior to the tinkering in the 90s to make it look a lot more politically less sensitive. And that Shadow Stats inflation number is now 15.1%. We talked on the show that it had crossed 13%. That means you're losing more than 1% a month in your cash positions. Why are you sitting in cash? Because that's a guaranteed theft. That's a hidden tax, a hidden theft on your cash position when you think that you're being safe. And that's the highest level, Miles, since 1947. You're talking the heart of World War II.
Right.
You can explain it away there. Here you can't. And it's just devastating to people that aren't getting cost of living adjustments to match.
At 15%?
Yeah.
You'd be lucky if you're getting 2.
Oh, exactly.
Yeah, Tori, and let's say that the Fed decides it wants to curtail and taper back some of that inflation and cost of living rises. You and I don't think that's likely, but let's pretend we're wrong and they do. We've spent a good number of years now talking about how gold does exceptionally well during inflationary periods, and you just look at simple things like, say, gold versus the Dow over the last 20 years. And it's pretty clear that gold is the clear winner on a long enough timeline. But you know what else does really well during periods of deflation as far as purchasing power goes?
Gold.
Also gold. And maybe that's going to be our conversation for the next year. I mean, everybody can look at a situation and say, well, yeah, of course hard assets do well when inflation is pushing all hard assets up. But they maybe haven't thought about why would something like gold work out better than holding cash positions in a deflationary system. And we've found, looking back through the 20s, 30s, and 40s and other periods throughout time, that gold actually does exceptionally well, and depending on what your capital gains tax strategies are, gold can actually do significantly better in times of deflation than inflation. So maybe that's going to be our 2022 discussion. Before we move on to the rest of 2022, let's make sure we're going to see a 2022, because there are some geopolitical things that we want to bring up, including, if I'm not mistaken, what did you tell me, $200 billion in funding?
Yeah,
going
defense
towards
funding
Ukraine.
to Ukraine. Oh, it just adds so much fuel to the fire. That, a preemptive strike in the Crimea region they've talked about. You're hearing it now. Watch and listen to the politicians. They're getting desperate. They need attention drawn somewhere else. They need it off of the economy. They need it off of policies that are not getting passed. You've got jobs on the line. You've got power and control and centralization on the line. So what happens in those types of situations? Tensions. And it's not just the United States. Tensions turn into conflict. And yeah, Miles, you've got the Russian-Ukrainian tension building, and you're getting a lot of media attention for a reason. You've got China and Taiwan that have tensions building. We've also sent mine ships to Taiwan to drop mines in that sea between them and China. So those are things that, yes, we're stoking fires elsewhere too. So keep your eye on the ball. And gold does very, very well in times of geopolitical tensions. The greater the tension, the more the gold price tends to climb.
That's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, hit the subscribe button or ring the bell. If you've got any questions, you can find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. Head on over to our website at McIlvaney.com. Or if you'd like to discuss your personal portfolio, we can be reached at 800-525-9556. Thanks for listening.
Have a great week.